24 seconds away from the opening bow this morning. Good morning to you. Equity futures just slightly softer, down 0.2% on the S&P. On the Nasdaq, down about 0.4%. Chairman Powell speaking right now on central bank independence. The Q&A session should start shortly, and when we get that, if we get some headlines, Mike McKeel will run to the studio for you. There's the opening bow. Switch at the board and get to the bond market. Big move at the front end over the last couple of days. The previous 2 days, the two-year yield down about 25 basis points. Trying to bounce here now on a 10-year yield up 5 basis points to 358.36. In Euroland, euro dollar 107.50. Euro dollar firmer by 0.2% on the euro side. Goldman earlier this morning dropping their recession call, and all of a sudden some optimism around the eurozone. We'll see if that sticks. Crude 75.40 at 1% at the moment on WTI. One stock to watch around the open is Coinbase, the crypto exchange initiating another round of layoffs and cutting 20% of the workforce. The CEO, Brian Armstrong, writing in a blog post, over the past 10 years, we became too focused on growing headcount as a metric for success. Especially in this environment, it's important to shift our focus to operational efficiency. Abby has more. Hey, Abby.
Hey, John. Yeah, and it's interesting because Brian Armstrong was also saying that this is the first time that there has been a downturn in the crypto space along with a macro downturn, sort of suggesting that that's a piece of what's going on. But one analyst at Oppenheimer saying that the reason that this company has now cut over the last 8 months in terms of company headcount for a third time, it has everything to do with the idea that volumes at their crypto exchange are down, especially after the FTX blow up. The stock, it's interesting, is higher today, up 1.7%. So maybe some relief on a stock that's down more than 85% since its IPO. The current cut about 20% or 950 staff. They cut about 1,200 people last June. They also cut 60 people somewhere in between. So more than 2,200 people over the last, let's call it 8 months or so, again, having to do with this slowdown in crypto trading. And they are cutting special projects. As a result, they're taking about $150 million in restructuring charges. So this is no small matter. And net income, back in 2021, when they did go public, they were putting up really solid net income of greater than $1 billion in 2 quarters, and in one case, close to $2 billion. Well, we're now looking at yet another quarter of negative net income. The crypto winter simply continues here, John. Very clear for Coinbase. But again, the stock is higher, so maybe find a little bit of relief.
Higher and keeps climbing. Abby, thank you. Now up by 8% on the session, 2 minutes into the open. Right now, equities almost unchanged on the S&P 500. Up 0.1% on the S&P, on the Nasdaq. Up 0.1% also. The restructuring we're seeing hitting firms across industries here. Apple's said to be looking at Broadcom, replacing those chips inside its devices with in-house components in 2025. With the latest reporting, here's Ed.
Yeah, good morning, Jonathan. We're down a percentage point on Broadcom. Not as severe as the reaction that we had when those headlines crossed. According to sources, what Apple will do is move away from the Wi-Fi and combined Bluetooth chip or modem set that Broadcom provides to Apple. This is actually a bit of a surprise because only back in December, Hock Tan, the CEO of Broadcom, talking about how good their chipsets were, how good their tech is. Less of a surprise is Qualcomm, because we've been talking about for a while how Apple wants to move away from Qualcomm. They've been in legal proceedings against them, and then as licensing settlement, which would lead to Apple having a 6-year period of cellular modems from Qualcomm, but then moving away in the future. Look, this is a big technological story, all right, about the modern day handset and Apple's move to bring not just supply chain, but do it itself on the technology front as well. We know that they're considering, generally speaking, how and where their handsets are assembled globally, but this is about controlling the IP and controlling the ability to update technology at a pace that suits them. For Broadcom, this isn't good. About 20% of their revenue comes from Apple, or about $3 billion. They account for around 7% of EPS. You see a lot of reaction on the sell side saying that the timing of this report is very interesting because Broadcom's most recent multi-year agreement with Apple expires later this year. So interesting move, fantastic reporting from Bloomberg's Mark Gurman. Less as a surprise, as I say, on the Qualcomm side.
Yeah, just to come to you on Apple just briefly, early February we get the earnings from them.
Yeah.
The stock's put a run of gains together over the last few days. Tough month though, over the last month. Yeah. Can you tell me just how low that bar is for that company?
Yeah, I mean, December was the worst month for Apple going back to May of 2019, and there was a complete revision for that full year 22 forecast in terms of overall handset shipments by a factor of around almost 20%, right, when you take into account all the different reporting around cuts. Ultimately, there is not demand for the lower end products, and there is demand for the higher end products products which they couldn't produce because of COVID disruptions in Zhengzhou. So it's going to be interesting to see not just the top line result, because those ASPs may come down, which will impact revenue, but also margins as well, as they kind of scramble to untangle everything.
Ed, thank you, mate. Looking forward to your coverage on that story. February 2nd is when we get Apple earnings after the close that day. That stock is up by 0.8%. In the near term, we're just days ahead of bank earnings in America. Jefferies reporting a profit decline of 57% in its 4Q results. Shanali Basak on top of the story. Hey, Shanali.
John, you have to wonder if Wall Street's windfalls are now over and how long those windfalls are over for. You have a firm like Jefferies where you're watching investment banking activity fall off. However, you also have them saying that this is still one of their best years that are ending on ever, as well as activity levels not really going back to where they were in 2019. Still, Wall Street does not love it, because once you have activity start to drop off in that kind of way, you have a different equation in terms of how you meet margins, how you turn a profit when you're not willing to let people go. When it comes to Jefferies, they are still trying to send that signal that they are holding on to staff, they are looking for great staff, and of course that report of Sumitomo a couple of days ago potentially increasing their stake. Jefferies itself did not answer to that, but at a time like this, competitive business on Wall Street, at a time like this, you like to make some more friends to drum up more business. Now, John, what does this mean for the banks that are coming up ahead? Jefferies, yes, the investment bank, no shocker, their activity falling off, but when you look at equities, also under pressure. Fixed income is a big winner here, which bodes really, really nicely, of course, for JP Morgan and Goldman Sachs, potentially even Morgan Stanley next week. Let's see if that's enough to keep the boom times going for these banks here, and whether it's enough to ink them some more money at a time where so many business lines are under pressure.
It's slightly unfair of me to ask, but if you could have one earnings report release right now from any bank on Wall Street, Shanali, who would it be?
You know I love my children equally, but, you know, I think that it will be interesting to see what the big consumer banks do. Those provisions for loan losses are expected to tick higher, and the question then becomes how much. We know investment banking is under pressure, but what about the consumer?
That's a good dodge, a very good dodge, Shanali. Looking forward to your reporting later this week. Thank you. 6 or 7 minutes into the session, the Q&A session just starting with Chairman Powell over at the Riksbank, the Swedish central bank. Mike McKee's going to drop by in about 5-10 minutes regardless, just to run you through what we're hearing from there. The takeaway so far, not hearing much. About 5 or 6 minutes into the session, call it 7, up 1/4% on the S&P, on the Nasdaq, up 0.4%. Looking cross-asset right now, you've got high yield spreads tighter over the last several weeks. You've got EM absolutely ripping. You've got the dollar weaker. It does not scream global recession. Corporate America could be bracing for a slowdown. And Cameron Dawson of New Edge is looking for signs of the downturn in the Treasury market. She says this: is the re-steepening of the yield curve, that's the one to watch. When the short end is falling, that is the best indicator of an imminent recession. Cameron, I'm pleased to say, joins right now. So Cameron, the jargon for this is the bull steepener. You get that big rally at the front end, yields drop more there than they do at the long end. That's what we've seen in the previous couple of days. Cameron, can you tell me why that's more important than just, say, pure inversion, which is what people obsess with?
Yeah, because the inversion of the yield curve tells us nothing about timing. It can lead a recession by as much as 24 months. It really is that re-steepening that tells us when we're about to enter a recession. And importantly, we've never seen risk assets bottom before that re-steepening begins. And so what that re-steepening means is that it has to come from lower front end yields, meaning that the front end of the curve is pricing in a lot of interest rate cuts by the Fed, meaning the economic condition is weak enough to justify the Fed moving much more easy, much more accommodative. But what's interesting is that if we look at the 2-year yield today, sitting at about 4.2%, that is below the projected Fed funds rate. But importantly, that 2-year yield is right on top of the Fed's own projection of its yield in 2024. That's the median dot in 2024. So it really will be important to see if we see a further rolling over of 2-year yields. That's when the market will be truly concerned that we're going into an imminent recession.
Cameron, how well aligned do you think that bull steepening is with what we're seeing elsewhere? EM absolutely ripping, the dollar weaker, high yield spreads in America much, much tighter. How well aligned are those things?
Yeah, I think you're exactly right, which is that the data does not support that we are going into an imminent recession, which is why we don't think that we've really seen that bull steepening kick off in earnest. And the reality is that data within the U.S. simply does not support the Fed easing policy. And so we think even though we're not getting those hawkish comments out of Powell today at this meeting, we would expect further hawkish comments out of other Fed members as we go into the next Fed meeting in early February, simply because financial conditions, as you said, the dollar weakening and markets rallying, credit spreads tightening, they're all indicative of financial conditions now being as easy as they were back before the Fed's meeting back in August at Jackson Hole. And so that's when Powell really pushed back hard. And so we would expect further pushback again.
Well, Chairman Powell speaking right now in a Q&A session. One line here, the Fed tools work. One tool for the Fed, Cameron, has been Fed Speak. And I just wonder how powerful, how efficient, how effective that Fed Speak has been over the last week, because they all sound hawkish. And as you've indicated, the two-year yield has started dropping in the face of that. This at a time when we've got sub-50 ISM readings as well. Cameron, do you think this market's responding to this Fed Speak in a different way?
Well, I think we're locked in this really tough game of chicken with the Fed because the bond market is still pricing in those 40 basis cuts into the back half of this year. And if you listen to Bostic yesterday, he said, I'm not a pivot guy, and asked how long he would keep rates high. He said a long time. And so the bond market completely disagrees that the Fed can hold its resolve and keep rates really tight. And it really is a question of if we start to see hard data start to roll over, because all of the weakness that we've seen within economic data has really been within soft data, survey data, sentiment data. It hasn't really showed up in real activity yet. And I think that's the big question for the Fed as we move into the next couple of months. Will we see things like jobless claims really tick up? Will we start to see income soften even further? And as of yet, we're not seeing that yet, which is why the Fed continues to talk so tough.
Well, Cameron, can I ask you a question that I asked our panelists a little bit earlier, Matt Hornback and Matt Miskin? I think it's an important one. What would you tell investors to position for? Should they be pricing an economic slowdown off the back of all this tightening, or an economic rebound off the back of China reopening? Which one is it?
That's such a great question. I think our preference when we're positioning is to try to be as agnostic to that path as possible, meaning buy companies that you can hold through different market cycles, quality companies that don't need the Fed being super easy in order to bail you out. Because we don't think the time to add beta and liquidity is really until you see a true pivot to accommodation by the Fed. So it means keep a little bit more defensive. You can layer in some cyclicals, but it has to be quality. So for example, we added a little bit to materials in the event that you do see a reacceleration in global growth, you do see a weaker dollar because of because of China reopening. And so I think that you have to be positioned for multiple outcomes, but the one we do not expect is a really easy policy shift in the very near term.
Favorite sector right now, Cameron? What is it?
So we like the combination of financials right now simply because of very, very low expectations. If you look at who has the easiest bar for earnings growth into next year, it is those financials. They saw their earnings decline 17%. Look at Jefferies in the fourth quarter, down 50% in earnings. That just creates an easy bar for earnings growth this year. And then we like to pair it with some more defensive sectors like healthcare, because we do think that in the event we do have an economic storm, you want some stability within the portfolio to be able to have stable earnings in an uncertain environment.
Hey, Cameron, thank you. This was great, particularly on the bond market. Enjoyed that. Cameron Dawson there of New Edge. Thank you very much. Your equity market looks like this about 13 minutes into the session. We're positive a little more than 1/10% on the Nasdaq, up 0.2%. No big headlines just yet from Chairman Powell. Mike McKee's going to jump on set in just a moment. Coming up, we'll talk politics as well. President Biden turning his focus abroad amid pressures at home.
All options are open. I mean, this is why we have, CUSMA in Canada, USMCA in US, and TMAC here. I mean, it's an agreement that also provides for mechanisms for dispute.
That conversation up next.
options are open. I mean, this is why we have, CUSMA in Canada, USMCA in US, and TMAC here. I mean, it's an agreement that also provides for mechanisms for dispute. But of course, as trading partners, and trading partners that are like us, Canada, US, and Mexico, who do enormous trade volumes. I mean, I would say that this is one of the most successful trading relationships in the world.
President Biden in Mexico City for the North American Leaders Summit. Amid mounting tension at home, the DOJ reviewing classified files found in the president's former office. Plus, the White House facing questions over former President Jair Bolsonaro's presence in the United States. Team coverage starts right now. Bloomberg's AMH in Mexico City. Emily Wilkins down in D.C. AMH, walk us through the agenda today.
Well, Jonathan, first we're going to have a bilateral meeting just between President Biden and Prime Minister Trudeau. And then, of course, the three amigos, what they're colloquially known as, is the North America Leaders Summit. They'll meet together. And already from what the White House is saying in terms of their fact sheet of deliverables, we can get a little bit of a sense of what they're going to be speaking about. Semiconductors plays a huge part in these discussions. They want to initiate a new semiconductor forum. They want to look at the labor intensity and the labor needs in terms of the workforce in North America to work in the semiconductor space and also shore up and integrate those supply chains a bit more. They're also going to talk about climate change, not just reducing emissions, Jonathan, but plans to install electric vehicle charging stations along their borders. And then finally, of course, migration, which is a huge issue back in the United States. They're going to try to coordinate more, share more intel and information on migration and on drug trafficking. When it comes to migration, Jonathan, they will be announcing a new portal for individuals who want to come from South America to apply to either go to Mexico, United States, or Canada.
Anne-Marie, just on trade, nearshoring has been a massive theme for a lot of people looking out to 2023, the year ahead, and for that matter, the decade ahead. Mexico, the big winner there.
They are a big winner. Already we see Mexican exports to the United States increasing. And AMLO didn't mince words yesterday with President Biden, talking about the fact, though, that he still sees ships from Asia with goods from Asia showing up in Pacific ports. And he really wants the United States to have more investment in Mexico. He wants the U.S. to not just back them when they go to development banks, but also jointly approach companies to build more in Mexico so they can supply the parts needed for, say, a manufacturing plant in Arizona.
Emily, that's the situation abroad in Mexico. Can we talk about the situation at home? Can you explain this to me? So we've got these files at the former president's office, and now we've got the DOJ reviewing classified files found in the current president's former office. Can you run us through that?
So when Biden was vice president, he did have a role at Pennsylvania University. He had an office that he used. And Biden's lawyers said that they found, that they found these classified documents in this office in a closet. They said they have notified the National Archives, which are now in possession of the documents. But of course, this raises questions about what Biden was doing with these documents. It raises a lot of concerns given how much hand-wringing there has been over the documents found at Mar-a-Lago. And I think this really opens up a lot of questions. This is not going to be the last that we hear of it. Republicans are more than ready to begin a number of investigations today. They're going to be looking into things including China, the origins of COVID, Hunter Biden's laptop. Expect to hear more of that. And this is something that they can very easily add to the list of things that they really want to dig into.
I can't keep up. That's your job, not mine, I guess. Emily, down in D.C., Emily Wilkins, thank you. MH over in Mexico City, Anne-Marie, thanks to you as well. Fed Chair Jay Powell, for those of you following, participating in a conference at Sweden's Riksbank. Mike McKee back with us for more. So, Mike, it's about central bank independence. There's a few of them sitting around facing some questions. Have we learned anything so far, Mike?
Nothing really. There is a question just posed to Jay Powell about liquidity in the system, and he says that he would prefer that we focus on structural reform rather than liquidity reform, but that's the closest you've gotten to anything on perhaps some kind of monetary policy. He was asked about whether the Fed felt the policies that the Fed followed during the great financial crisis and the pandemic crisis had worked, and he said yes, but that was in the context of changing policy so that Treasury had to be involved. So Treasury had to approve the methods that they used in the pandemic response. So it's still really all about central bank independence so far.
Well, Mike, you'd have to think they could ask a question here about the need of central bank independence at a time that they're explicitly telling us they're trying to put unemployment higher to get inflation lower. Don't they need independence to achieve something like that?
Well, he did say that central bank independence is helping the Fed because they have to make unpleasant decisions, things that people will disagree with to get to price stability, and price stability is the ultimate goal for the Fed. But you also have to remember this is a panel with 4 central bankers on it, or 4 current or former central bankers on it. So Powell is not the main focus, and he doesn't get all the questions.
And maybe you're not getting the diverse views you might be looking for. Mike McKee, thank you. Hugely controversial, that effort, I know, for many of you at home and beyond. 22 minutes into the session, equities down 1/10% on the S&P, the Nasdaq lower by 1/10% also, with some sector price action. Here's Abby.
Well, John, a little bit of a sleepy day here for sectors, and that small decline for the S&P 500 right now, fluctuating. It has been fluctuating in the first half hour of trade on below average trading volume. This means that we do not have any sector trading. Well, we right now have utilities up or down just a little bit more than 0.5%, but across the board, very small moves. Utilities down. This, of course, as yields are higher, making those dividends look less attractive. Healthcare is up top, discretionary up just slightly. Let's take a look at one tech sector that's moving just a little bit more, and that, of course, the chip sector. The stocks down about 0.6%. Broadcom, as Ed and you had been discussing earlier, Apple planning on making its own components. The stock down about 3%, but not so much. I can remember reporting on that possibility all the way back in 2016, 2017. So there's been a lot of knowledge of that in advance. But yesterday, this sector had a pretty good day. Today, giving back a little bit of those gains, John.
Abby, great work. Thank you. Over in Sweden then, bit of a snooze, quiet, not much news whatsoever. You know your next stop. CPI on Thursday, earnings on Friday. Your trading diary up next. Right now, 3,900 on the S&P. That's the level that Mike Wilson says is an easy sell. Are you a seller of this? Equity futures right now, or rather equities, are up by 0.25% on the S&P. That's the price action. Let's get you the trading diary. President Biden speaking alongside leaders at Canada and Mexico at 4:45 Eastern. Fed speak from Harker Bullard barking on Thursday. Plus, CPI data just around the corner. Jobless claims as well. Then on to Friday. JP Morgan, Bank of America, Citi, Wells Fargo, all kicking off big bank earnings at the end of this week. From New York, that does it for me. Thank you for choosing Bloomberg TV. This was the countdown to the open. Good luck for the rest of the trading day. This is Bloomberg.
from the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Tuesday, January 10th. Here are the top market stories we're following for you at this hour. Powell is ready to be unpopular. Fed Chair Jay Powell backs up a hawkish Fed. Just how mean is he going to have to be? Stocks actually pushing higher, yields also up. And the inflation waiting game. The clock ticks towards the next piece of market-moving data as investors try to figure out just how fast inflation can fall. And Slim Jims and Hungry Man. We talked to the CEO of Conagra and get his take on margins, consumers, inflation, and jobs. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, I appreciate that everyone's going to say that the panel that Jay Powell was on was not appropriate to talk monetary policy, but the markets were definitely anticipating more hawkishness, didn't seem to get it, and now those financial conditions a little bit looser.
I find it amazing that every time Powell doesn't sound hawkish, the market takes it as dovish. I think we may have things a little messed up here. Out of interest, what's a Slim Jim?
Oh, it's the thing with the dried beef. It's like a dried beef and you open it, eat it. Meat stick.
Okay, just had to check because I've never heard of one of those before, but no, it sounds delicious. Yeah, I don't know. Powell says he's happy to be unpopular. Are central banks meant to be popular? I'm not entirely sure. I guess they're there to take the punch bowl away. The problem is, though, that they've been, over the last few years, filling it up with punch, so maybe that has been the new kind of normal for central banks. But Alex, yeah, I think I find it amazing that we're in this situation. Mary Daly yesterday, Bostic yesterday, Jamie Dimon today, talking about 5% plus rates and holding them there. Is that going to be enough to make the Fed unpopular? Maybe, because the market's pricing cuts. What do you think?
I don't know, because I don't know how much the markets are going to actually wind up listening when you're looking at a full cut now priced in for July. I mean, that's not necessarily something that the Fed's going to want to see and goes against everything that guys like Bostic are talking about.
Absolutely. One thing that is, though, clear is that Jay Powell doesn't think he can control the weather, which is interesting because pretty much controls everything else. Anyway, he was speaking, as Alex says, at the Riksbank conference in Stockholm, and actually the focus on the panel that he was on was what was happening with climate and how central banks should kind of deal with that. This is what he had to say on that matter.
Without explicit congressional legislation, it would be inappropriate for us to use our monetary policy or supervisory tools, for example, to promote a greener economy or to achieve other climate-based goals. We are not, and we will not be, a climate policy maker.
Okay. I suspect, actually, they've probably got enough on their plate right now over at the Fed. So will 5% make Powell unpopular? That is our question of the day. Joining us now to discuss, Bloomberg's Kriti Gupta and Mike McKee. Kriti, I'm going to start with you. The market continues to price in cuts. The market continues to believe that we're going to get up to maybe circa 5%, and then we're going to kind of go from there and come down fairly quickly. What is the market currently expecting from the Fed, and what do you think would make it unpopular?
Well, it's a 5.2% policy rate, peak policy rate, I should say, that is getting priced into the market right now. And this has been the story, I want to say, for the last few months here, that they're expecting that peak policy rate to come somewhere between March and May. So the 5% itself is not what's going to make the Fed unpopular. Right now, I think it's not cutting is going to make them unpopular, which the irony here is that that is exactly what's priced into the market. And we, of course, have heard over and over and over again that Chairman Powell and his colleagues have said, look, we're not cutting this time around. It's just not something that's in our toolbox. But the argument on the market side is, well, it's been a part of your toolbook, or toolbox, I should say, playbook, toolbox, pick your wording, for the last 2 decades almost, where you are using that kind of rate cut as a means of saying, look, we can go over if we need to. And you heard those comments as recently as yesterday from Raphael Bostic over at the Atlanta Fed, saying that, look, the risk of overdoing it with the Fed, it is a possibility, but maybe the Fed does at the end of the day need to overshoot. So I think that is what the lack of rate cuts is what would disappoint the market.
Mike, what do you think? 5% or lack of rate cuts?
Uh, it depends on who you're talking about in the markets, because there's sort of two views. One is the Fed's got to cut rates because the economy is going to fall into recession, perhaps because the Fed tightens too much. And then there are others who say the Fed's got to cut rates because inflation's going to disappear and the economy is going to be in good shape. So which group are you in? Well, you know, that'll depend on whether you are happy or not. It is going to really depend on how the economy develops, I think, and the market will change its view as time goes on. If we do see inflation significantly fall, more pressure will arise. If we see the economy really start to slow, you'll have pressure from a different camp. And the Fed's just going to keep an eye on things and see what's going on. You had a research paper out from Goldman Sachs today that said the full brunt of the Fed's tightening policies are hitting the economy right now. The long and variable lags are actually short lags. And so the economy is likely to grow faster in 2023, and the Fed may have to raise rates higher. And they say it is possible, not likely, but possible, they'd have to go to 6%. Now that would make the markets unhappy.
Let's get, Mike, let me come at this from another angle. The market wants a soft landing. But I would assume that a soft landing means that the Fed doesn't have to cut rates. Because if it can achieve a soft landing for the economy without cutting rates, happy days. It can leave rates structurally higher for longer. So I'm wondering which one of those two would make the market unhappy. Is a soft landing going to make the market unhappy because it will not be accompanied by rate cuts?
Somebody pointed out the other day, I think it was Paul Krugman, that the Fed never gets to declare a soft landing, that they're always adjusting policy because the economy is always adjusting. You can't say when a soft landing hits. So I don't think what you'll see is the Fed looking at a particular level of unemployment or a particular level of GDP and saying we're there. They will react to what inflation is doing, and they've made it pretty clear that they want to see inflation strongly moving towards 2% before they even start to think about cutting rates. And whether that encompasses a soft landing or not, it's hard to know.
Which brings us to what markets are pricing in then for Thursday, Kriti, because there's like two camps. One camp is inflation is slowing a lot faster and a lot harder than we thought, and the other is that we're still going to be sticky, and 3% or 4% isn't going to be enough if you take a look at the core services ex housing. Where's market position the most?
Well, I think what's interesting about that is the idea that it's not, I mean, everyone's going to say this is not going to be a straight line down, even though you are seeing that deceleration in inflation. And that's why I think the sensitivity to the wage growth numbers and the payrolls kind of data set has become an even bigger trading point in the last, I want to say, 2 data sets that we've had, and that's actually moved the market more than CPI has net after the reaction, 30 minutes after the reaction, because you tend to see the move get paired. And I think that's really important to talk about, because even though if we see the core services data come down a little bit, it's that wage growth data that's still the issue. The assumption baked into the market is that inflation is going to come down in 2023. And even Gina Martin Adams over at Bloomberg Intelligence has said, when you have inflation coming down, volatility is going to come down too. So the markets will get some sort of boost, some sort of piece of calm, or in whatever phrase that makes sense there. But I think what's really important to talk about, though, is that the wage growth is something that's much, much harder to price in, and it's not clear that that's coming down as consistently as the core numbers are.
Guys, this was fun. It's like a kind of a round table, except guys not here there. But thank you for joining us. Really appreciate it. Kriti, Michael, thanks a lot. I appreciate that. All right, coming up, more on our question of the day. Will 5% make Powell unpopular? How do you position Kate Moore of BlackRock? Is coming up next. This is Bloomberg.
I think that the tools that we have work. I think there's nothing wrong with our mandates. I don't see anything about the laws that govern us or provide our mandates that needs to be changed, and it seems to have worked pretty well in these 2 very difficult circumstances.
Next week, Bloomberg is live at the World Economic Forum annual meeting in Davos, Switzerland. As energy crises loom, wealth inequality intensifies, and global power dynamics dominate headlines. Trust Bloomberg for the fastest coverage and exclusive analysis from the world's top leaders and experts. Coverage begins next week, only on Bloomberg Television and Radio.
It's essentially this idea that there is a terminal, endpoint to the hiking. You don't necessarily need to see the easing, and the market is probably, and I think we're going to hear this in a few hours, incorrect in believing that there's going to be any sort of material easing in 2023.
That was Julian Emanuel of Evercore earlier with his outlook for the Fed and rates, which takes us back to the question of the day. Will 5% make Powell unpopular? Joining us now is Kate Moore, BlackRock's head of thematic strategy for its global allocation team. Kate, really good to see you. What does a 5% plus rate mean for the market? How much will the market hate it?
Well, I think the question is a good one. Does 5% make Powell unpopular? And I think it's really important to recognize that Powell is not solving for popularity at this point. He's really solving for his legacy and what history books write about how he managed this really challenging economic period. He doesn't really care what equity investors like myself think about 5% if it achieves the right goals in terms of employment and achieves the right goals in terms of inflation. And I think that's a really hard thing for a lot of equity investors to get their head around, is that, market levels are not what the Fed is really focusing on. And they're not saying words to encourage us. They're not saying words explicitly to discourage us either. But at the same time, we are not the game.
Yeah, inflation is the game. Kate, as you say, good morning, it's Guy. And I'm fascinated that the market believes that we are on this glide path back down to 2% inflation, that it's going to be pretty straightforward from here. Are we underestimating just how difficult it's going to be? Powell's talked about the challenge here. He clearly doesn't want to go back to the 70s and make the mistakes that were made then. Is the onus still very much on doing more rather than less?
Yeah, I think the onus is going to be on doing more rather than less. And as people have discussed on the show previously, and as that clip you just showed from Julian Emanuel said, we're likely to get to a rate and stay there. One of the things that sort of confused me, Guy, has been that the market doesn't seem to want to believe anything that Fed speakers are saying. People give a very clear message, these policymakers, and then the market's like, yeah, I don't really believe you. You're going to actually have to change your mind. We're right, you're wrong. And I think we need to get to a place where we really take them seriously and take them at their word. That once we get to a rate that they feel is appropriate for the economy, they're going to hold that rate for a considerable period of time, to use that phrase over and over again. And I don't think that's going to be a bad environment for equities, by the way. You'll have a level of certainty. We're staying here. There's going to be no significant policy changes. We'll see the economy and companies adjust to that higher policy rate. And I think a much better environment for risk assets once we hold.
What risk assets?
Equities in particular, that's what I'm focused on. Although, to be fair, in our fund, we have considerably increased our allocation to credit, and we think there's a huge opportunity there to get good total returns over the course of this year. But, in the near term, I think there's too much uncertainty for equities. Look, I love my asset class. I like to be a bull. It's uncomfortable to be uncomfortable with this current market move right now and the green on my screen. But I think we need to get through fourth quarter earnings, and not so much what happened last quarter, but how companies then talk about how they're going to be managing input costs, how they're going to be managing slow revenue growth in 2023, and talk about their guidance for the full year before we can really get a picture for what the fundamentals will look like. So, I'm kind of a holding pattern when it comes to equities at the moment, but I do expect once we get past some of the policy uncertainty and get past some of the earnings uncertainty, we'll be in a better environment for stocks.
Kate, are U.S. stocks still expensive?
Well, Guy, they're not particularly cheap. I'm not sure they're as expensive as some people have claimed. Sure, the U.S. trades at a premium multiple to the rest of the world, and that's been an argument some people have used for allocating more outside of the U.S. But frankly, U.S. companies deserve a premium, not just because of the strength of their balance sheet, for their debt profile, for their agility, for how well they've managed more challenging economic environments in the past, and really managed their margins in rising input cost periods. So I think they deserve a premium. It's a dynamic group of companies. That said, it's not cheap, and I think you have to really pick your spots in the U.S. equity market right now.
Outside of the U.S., do you pick spots in, say, Europe or emerging markets, particularly if China reopens?
Yeah, look, I think there are some more interesting opportunities than there had been in the past outside of the U.S. And we've been adding a little bit to our international exposure in the fund. There are some areas in Europe, those companies that are geared towards kind of secular themes around the energy transition and industrial spend and automation. Those are interesting themes. We also see opportunity kind of more near term in some of the European financials. And, you know, we're looking at emerging markets closely. You know, resources has been a place that we have had a considerable overweight. And, you know, emerging market plays on that I think are going to be an interesting alpha generator in 2023.
Kate, the big difference between Europe and the United States over the last 10 years has been tech. Strip out tech, the comparison is easier to make. Do you think tech has fallen? Are you in the camp that still wants to buy tech, that still thinks there's going to be an opportunity in tech? Or do you think the tech trade is going to be done for a while?
Yeah, I'm not in one of those, the camp that says, like, for the next 10 years, tech is done, we've already had the leadership and it's all over. I mean, technology innovation, the need for technology across all different industries really creates a fertile environment going forward. Do multiples need to come down a little bit further if rates continue to rise? Yes, probably. But we're going to really separate the wheat from the chaff here. We're going to see some companies really continue to grow their revenues in a slower economic environment. And I think, you know, and this is in the technology space, and that will bring attention back. We got to remember, we got to look past the big mega cap tech and look at some software and services and even some hardware companies that have the ability to grow over the medium term. Everyone just focuses on the top couple names and forgets it's a giant sector that's important for all parts of our economy.
Real quick before we let you go, dollar up or down this year?
Oh, I'm going to chicken out, Alex. I'm going to say dollar is going to be range bound to flat. Yeah. I find dollar predictions incredibly difficult, but I don't expect the same type of appreciation we saw in 2022.
U.S. exceptionalism, maybe in the equity market, but not in the foreign exchange market. Kate, thank you very much indeed. We always appreciate it. Very nice. Kate Moore of BlackRock. Greatly appreciated. Thank you. Okay, still ahead. Failure to launch. Virgin Orbit shares tumbling today after the company's first rocket launch out of the UK failed. We're going to have more on that story next. This is Bloomberg.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ritika Gupta. Crypto exchange Coinbase will cut about 950 jobs as it tries to weather a slump in the industry that's lasted more than a year. The cuts represent about 20% of its workforce. Coinbase says this restructuring will be substantially complete by the end of the second quarter. Bloomberg's learned that the drugstore chain CVS is exploring an acquisition of Oak Street Health, which runs primary care centers for Medicare recipients. A deal could value Oak Street at more than $10 billion, including debt. Shares of Oak Street are soaring today. And Bloomberg's learned that Microsoft is in talks to invest up to $10 billion in the creator of artificial intelligence bot chat, GPT. A proposal calls for Microsoft to invest the money in OpenAI over a period of years. The two companies have been discussing the deal for months. And that is your latest Business Flash. Alex.
All right, Ritika, thanks a lot. So it is 7:22 on the West Coast. Let's get to the startup. We covered some top tech stories from the Bay Area and beyond as Silicon Valley starts its morning. But today we're going to take that view from New York. It works. Bloomberg Technology co-anchor Ed Ludlow joins us now. All right, Ed, let's talk about this Virgin Orbit not working. What happened? What do we know?
So this was their 6th mission, but the first from the UK. For our global audience, there's a part of the UK called Cornwall in the southwest, the kind of very tip of the country. And this was a really big moment for the UK space industry. In the UK, they're great makers of satellites, but not launched. So the 747, you see it on your screen now, takes off from Newquay, climbs to around 35,000 feet. The rocket, which is underneath one of the wings, detaches, blasts off, goes into orbit, and at around 11,000 miles an hour at 35,000 feet, it starts this sort of classic separation, stage 1 and stage 2. What we know is that when that happened at stage 2, there was some sort of malfunction, and ultimately the payload, which is satellites for small sat makers and operators, were not deployed. What was awkward is that Virgin Orbit tweeted that they'd successfully reached orbit, so everyone assumed it was well. They then had to delete that tweet and backtrack, and there's a pretty significant stock reaction. Why? This is a company whose financials are a little shaky, and this was a big mission for them.
Absolutely. Cornwall on the map, though.
Yeah.
We'll see what happens next. In Scotland, we're going to see some vertical launches. We'll see how those go. I imagine the weather windows are going to be maybe a little bit more limited. Ed, just talk me through how many... if this was to happen again, how precarious would the position be? How close to the edge is this company now?
Yeah, all I can do is look at their balance sheet, right, and use the Bloomberg Terminal FA Go. They had about $70 million of cash and cash equivalents as of the third quarter, but throughout 2022, they burned through that cash, right? They booked meaningful revenue in that quarter too. What I don't know, and I'm going to ask the company, right, is can you book revenue on satellites that are not deployed? Then there's the kind of PR exercise around this, right? The UK Space Agency, the UK government, all of our compatriots in Cornwall were so excited about this. It was bigged up massively as kind of the dawn of the UK space launch age. Okay, it's from a plane, it's not vertical liftoff, but it's kind of an embarrassing moment, and all we can go on, right, is the severe stock reaction to this. We were due to speak to executives from the company and Richard Branson. They've pulled out, and we have so many questions for them. It's just interesting that they're not engaging over this.
Before we let you go, I do want to hit on Apple. So Bloomberg News reported that Apple is replacing Broadcom chips inside its devices with some homegrown. That's the onshoring conversation. Broadcom stock is down by 3%. Walk us through what we know here.
Yeah, this is a surprise insofar as, very recently Broadcom CEO was talking about how good, particularly their modem or chipset for Wi-Fi and Bluetooth is. That's what we're talking about here. So Broadcom currently makes that component for iPhone, for Apple handsets. According to sources, by 2025, Apple wants to use its own in-house designed chipset or modem for Bluetooth and Wi-Fi. We already knew, for example, that they were moving away from Qualcomm for the cellular modem. Sources say that will happen as soon as 2024. So the stock down, it's reacting. Analysts point out that this is bad for Broadcom, right? Apple's around 1/5 of revenue, 7% of EPS. And that timeline that sources outlined to us, very interesting. Seems to be happening quickly.
Do we know where Apple is going to be making these chips then?
I think this is interesting because of that timeline, right? So the shift from Broadcom Bluetooth Wi-Fi modem by 2025, we know that, for example, TSMC is investing heavily in the state of Arizona, United States. Could they manufacture that chipset on Apple's behalf in that time period? That is certainly a possibility. Otherwise, we'll keep digging and reporting, Guy.
Great stuff. Look forward to it, Ed. Ed Ludlow today, more Wall Street than West Coast. He'll be back on the West Coast soon. Ed, thank you very much indeed. Coming up, the largest public pension fund in the United States is making a big bet on small firms. We're going to speak to the CalPERS CIO, Nicole Musico, about her billion-dollar investment plan. This is Bloomberg.
We're about an hour into the U.S. trading session. Stocks are higher. Bloomberg's Abigail Doolittle tracking those moves. It's like nothing from Jay Powell is now good for markets. Nothing is good. Nothing is good. Well, right now at this point, we have the S&P 500 up slightly, fluctuating. It had been down a little bit, up a little bit. Let's see how the day goes. The NASDAQ doing just a little bit better, up about 0.25%. And the U.S. 3-year yield, it is higher by about 5 basis points, perhaps around Jay Powell just a little bit, although I'm not sure how much talk of monetary policy is coming out of the meeting in Sweden. There is an auction later today of these 3-year yields, so perhaps a little bit of a move lower for price ahead of that. And then you have crude oil basically flat. So lots of small moves here outside of bonds. Relative to the year, though, we're looking at a pretty good start. We've been talking about this over the last couple of days. If we go into the Bloomberg terminal, we will see this. Right now, the S&P 500 up about 1.25% over this time period. Often when you have stocks higher in the beginning of the year, in January, it can augur well for the rest of the year,
especially if January itself is higher. Of course, we have to get through earnings season and a slew of data, so we will see how that goes. If we flip up the board here, we will see that the dollar is one big piece of this story in terms of at least why stocks this year have been doing relatively well. It appears to have put in some sort of a peak last October. Technically, we were looking at it yesterday, breaking to the downside. A down dollar tends to help out risk assets. Speaking of risk assets, let's take a look at some of the tech stocks out there. We do have, at this point, Apple trading lower, down about 0.8%. Yesterday, they, of course, made the announcement. Not a really surprising one. They plan on taking, making the chips that are supplied right now by Broadcom in-house. This has been in the works for a while. Broadcom not down so much at this point because of this, down 3.1%. And then you can see Qualcomm, another chip maker, now fluctuating lower. It had been higher earlier. And then Microsoft up about 0.6%. Guy, it's interesting. There's a small software company, Informatica. It pre-announced the upside. The stock had been higher earlier, but not so much now. The reason I bring that up, it could be good for some of the other software companies. We'll be watching that one in terms of maybe fourth quarter wasn't as bad for some software companies as feared.
It's going to be an interesting reporting season, isn't it? Abigail, thank you very much indeed. Abigail Doolittle, and what we're seeing in the markets this Tuesday. Let's talk about one of the biggest asset managers out there. CalPERS announcing today that it's investing $1 billion in upstart private equity firms. The largest public pension fund in the United States is hoping that taking a stake in smaller managers run by women, minorities, could boost its returns and reputation. It's focused on the latter. Joining us now, Nicole Musico, CalPERS Chief Investment Officer, and Bloomberg's Shonali Basak. Shonali, over to you.
You know, it's interesting, Nicole, when you look across the market, there's this general sense that the bigger some of these firms get, these alternative asset managers, that they lose some of that entrepreneurial spirit, that ability to make one-by-one returns across the portfolio when you're managing $500 billion to $1 trillion. I'm wondering, when you're taking stakes in smaller managers, when you are looking to seeding new firms, is part of it an affirmation of that?
Yeah, I think that we've been very fortunate to see tremendous data come out over a number of years, that there's an entire ecosystem of these up-and-coming emerging managers, often many of which are run by diverse or underfunded minorities, if you will, and they are absolutely outperforming or at best competing very, very well against their peers. And so we see this as this amazing ecosystem that's been very untapped and very undercapitalized by most of the long-term patient investors.
How does it fall in also to kind of the larger perspective here at CalPERS? You made a lot of news when you came out last year and kind of announced your strategy to the board of CalPERS, largest pension in the United States, and this idea that you can do more on your own. You can bypass the larger managers.
Yeah, I think bypassing the larger managers is probably a bit of a stretch. I think that it's extremely important for us to continue to have very strong strategic partnerships with the larger managers. We need that in order to hit our strategic asset allocation. We need that to build in-house capabilities, et cetera. But that doesn't mean that we shouldn't be constantly seeking out pockets of excess return. I think this whole initiative in its entirety is not only about excess returns, but it's also precisely to give us the ability to start having some knowledge transfer. It really fosters a culture of entrepreneurialism. And so I'm really excited about not only the excess returns that we're seeking, but the benefits that it'll have for our team as we evolve into being able to do more and more alongside strategic partners, and in addition in the future on our own.
Nicole, hi, it's Alex here in New York. Hi. Nicole, to that point, talk about the private market versus public market returns, as pension funds are just really struggling to get a solid, the kind of returns that they really need.
Yeah, I think for CalPERS, we were a bit late to the game, or maybe we took a pause. I reviewed that during our last board meeting, where we really had an era of almost 10 years where we had stepped out of the private market space. We're in catch-up mode. We've been doing a good job in the last number of years before I arrived on the scene. But now our focus is making sure we're looking at the entire ecosystem of private markets, from private equity, infrastructure, real estate, private credit, and really looking to build up our own in-house expertise, looking to build out strategic partnerships, and then eventually really growing into our own so that we can start doing co-investing alongside partners or on our own.
Nicole, there's been a lot of concern about how private equity sort of manages whatever's coming in the next few years in terms of markets, right? Like maybe that's kind of leverage never really been tested in a massive downturn. How do you think about that when you look at markets on a day-to-day basis?
Yeah, we've been fortunate that we've been very focused on the quality of the partners that we've been investing in. We're confident that we're well positioned from a liquidity perspective. We ourselves have a lot of dry powder. Our partners have been on fundraising sprees the last number of years, and so there's a lot of dry powder in the system. And so we're still very confident about the opportunity within private markets in general and specifically within private equity. But we are looking for new pockets for excess returns, which is precisely why we think this initiative to commit $1 billion to these emerging investment managers, many of which are diverse. We think that there's tremendous opportunity for us to be generating excess return in that ecosystem.
Nicole, good morning. It's Guy. You talk about excess returns. What do you mean by that? Can you give us the size and scale of what you're thinking about?
When I say excess returns, really what I'm referring to is there's been this long kind of stated or understood notion that smaller emerging managers just can't cut it. They just can't compete with their larger peers. And so what I'm referring to is the fact that there's been a tremendous amount of work done to support the notion that smaller emerging managers can in fact outperform their benchmarks. They can outperform their larger peers. And so when I'm referring to excess returns, it's just seeking returns outside of what we're already getting by investing in the gen pop of private equity where we have been historically.
When you think about the longer term, when you think about what your pensioners are going to need going forward, is that changing? We now live in a world where central banks are struggling to get inflation back down to circa 2%. There is the definite potential that we could see inflation persisting for a longer period of time. Is your assessment of what returns are going to need to look like going forward now different than it was, say, 18 months ago?
I don't think the return bogey, if you will, for us has not changed. The need for us to be able to deliver to our members their pension promise has not changed. What has changed is our ability to execute on our strategy. So as of July, we have a new strategic asset allocation that the board handed down to us to be able to give us some more flexibility to be looking for outsized returns versus where historically we may have been investing. And so we're spending a great deal of time thinking more, especially in the context of the market today, what could we be doing more in infrastructure, for instance? What could we be doing more in private credit, for instance? And so we're continually trying to evolve our private market and alternatives program in order to meet the needs of our return threshold of trying to hit a 7% return, if you will.
Nicole, how much of this is an answer to the volatility in other markets, everything from the most vanilla of bonds really to equities? I mean, do you find that volatility difficult for you as a CIO of CalPERS?
I think everyone would say we've had quite a humbling period of time, and my timing of joining CalPERS, I guess, could not have been greater. But I'm very excited about the opportunity set we have in front of us because we were a bit late to the game in the private markets realm. We absolutely have a tremendous opportunity to be leaning into more alternative asset classes. We have a lot of dry powder. We're still looking to strategic partners to form, as I said, not only access to opportunity in and of itself, but also to build up our own in-house capabilities through knowledge transfer, etc. And so while it's
how much leverage do you have here? I'm really curious about, when you think about alternative asset managers and the fees they're charging right now. On one hand, they're also going through a difficult environment. On the other hand, you have some major funds like certain hedge funds, for example, that are having some of their best years in history. Are the hedge fund players here attractive to you given the market volatility, and do you have leverage when it comes to the fee structures?
Yeah, the hedge fund program at CalPERS was shut down prior to my arriving. We're certainly re-looking at that as a strategy as a whole. But as far as leverage with partners, I like to think of it more as how can we create kind of win-win partnerships with our strategic partners. I think you're right. Historically, it's been one of those mysteries, if you will, or one of those frustrations of large pools of capital that we've not had so-called more leverage with our investing partners. But if we're finding partners that are deploying capital and generating the returns that we need, then we're happy to pay for performance. At the end of the day, we're looking for partners that are going to deliver, as I said, the excess returns, give us access to co-investment, which ultimately not only lowers our fee base, but allows us to build up that in-house capability. And so we spend a lot of time making sure we feel that we're getting a good partnership overall in whatever that fee structure will look like. We are looking for more than just deploying the capital and waiting to see what the return is. We really need to have more of a hand-in-glove approach with the partnerships that we're forming, given that we're generally deploying quite large sums of capital in any given case.
Nicole, to circle back to the beginning and what you're doing right now in terms of the funds that you're going to be deploying, is this an ESG endeavor? What do you think about ESG? Are you convinced about ESG? How big a part is it going to play going forward in terms of the way you allocate assets?
Yeah, I would say, CalPERS has been a long-standing, I think, global leader in advocating for ESG in general. When I joined, one of the initiatives overall, overarching themes, if you will, that's very important to our board, to our stakeholders, to our CEO and our entire team, is this notion of being better, sustainable investors. And so we're spending a great deal of time thinking about what could we be doing and should we be doing more across the spectrum of our asset classes through the lens of ESG. So that's both through the risk lens as well as through the investing lens. And in short order, we'll have an announcement. We're bringing on a managing investment director of sustainable investing, for example. This is all to demonstrate that we think that this is an extremely important thematic for us to be weaving both through the risk and opportunity lens throughout our investment program.
Nicole, thank you so much. We really appreciate so much of your time today. We look forward to continuing this conversation with you. Nicole Musico, CalPERS CIO, and Bloomberg Schneider Bassett. Thank you so very much as well. All right, coming up, how COVID is now reshaping the insurance industry. We're going to hear from the Cigna CEO from the JP Morgan Healthcare Conference in San Francisco. Don't miss that interview. Coming up next, this is Bloomberg.